afternoon, ladies and gentlemen. And when Danny asked me to do this and talk a little bit about, I suppose, lessons we've learned through the crisis about competing at home and abroad, and also about, starting to grow our business in Europe, the only daunting piece of it was that there have been so many lessons as you try to, grow your business into Europe that, 15 minutes is a short period of time to do it. So I'm going to try very quickly just to give you some oversight as to what we have learned. I want to talk not too much about DCC, but it is relevant in terms of what I'm going to talk about, just to give you a little idea of the nature of our business. We're a sales, marketing, distribution and a business support services group. For better, for worse, we're one of those businesses. We don't actually really make very much. We're a route to market for a lot of large companies. I'll talk a little bit more about that in a moment. Where, geographically, and we'll come back to this, you'll see that we're very largely a UK business at this stage. 68% of our profits are UK. At this stage, 14% of our profits in Ireland, and approximately 18% in the rest of the world, which is really a grandiose terminology for continental Europe, because about 95% of those profits are European profits. We're spread across 5 businesses. 3 of our businesses on a pro forma basis at this stage are actually about 90% of our profits. We have an energy distribution business, an IT distribution business, and a healthcare distribution business. And then we have a couple of smaller businesses and some support service activities in there. Our turnover last year was 10.7 billion euro and profit of 185 million. Now, again, those businesses, what we're doing very briefly is we're representing, we have a buy-sell relationship with a very large number of oil majors, and while we have a buy-sell relationship, we're effectively their route to market. We're marketing and distributing oil products across the UK, Ireland, and a number of continental European markets. Similarly, on the IT side, we're doing similar things. We're a route to market for a large number of consumer electronics, hardware, software companies, and selling into the markets in the UK, Ireland, continental Europe, and doing similar things in our healthcare business, some support service activity there. But then we have our environmental business, which is quite different. It's not a sales, marketing, distribution business, and our food and beverage business, which is an Irish-based sales, marketing, and distribution business. So what has happened to our business over the last number of years? Whenever we look back on this in DCC, we get quite staggered by it ourselves. And we look at, as recently as 2000, which maybe seems a long time ago, there's been a lot happen. But, 54% of our profits were in Ireland. And actually, when you look in 2008, that number was still above 30%. Today it has grown quite significantly, and I suppose some of the things that have happened for us is that, we in our markets, we got quite large market positions in Ireland. If we're going to continue to grow, we had to look outside of Ireland, and I suppose like so many Irish companies, the first place to look, the obvious place to look was across the Irish Sea and into the UK. So we went off and we did that through the 1990s, and again we started to build and continue to build, hopefully, strong market positions in the UK in a number of our businesses. But as time has moved on, we can foresee a stage where again we'll end up with some large, hopefully, market positions in the UK, beginning to do that, and we're going to have to find some new platforms for growth. We've identified that in a couple of our businesses, and that's probably going to happen in more as we go forward. So the challenge for us really was to start carefully expanding our business into continental Europe. Just very briefly, before starting to talk about some of the things we've learned, you can see there that this has been a fairly recent phenomenon. We have had a business in France since 2000, and then in 2009, at the early stages really of the crisis, we moved into Austria and Denmark. And then in the current financial year, we've moved into a number of other countries. And if you were here for for Ronan Murphy's presentation, which was really interesting earlier, and talking about chief executives, saying, really looking at organic growth and, not so much looking at acquisitions. We've had to grow our business, and, we have a long history of growing our business by way of acquisition. But we don't have products that we can export across markets, because we're going back to what I said the business is. We're representing some very large global companies in a route to market, and they decide, market by market, how their channel to market, and you've got to be on the ground. You can't sit in Ireland and service these markets in our businesses. So what was our approach? You know what, again, we sat down a number of years ago and said, look, and particularly around 2008, and said, look, you know, this is going to be a challenge. There are going to be risks in this. And, you know, we had no German speaking, we had no Danish speaking, we have no, you know, Dutch speaking managers to put on the ground. So we had, you know, we had a lot of challenges in terms of building management teams and trying to get, you know, started in some of those markets. So we were very clear that we wanted to find, you know, an opportunity for modest initial investment, modest capital deployment. I mean, it might sound negative thinking, but at the end of the day, we didn't want to bet the shop on this and said, look, you know, we need to do things that if they go wrong and if they don't go as quickly as we have planned, that it's not going to, you know, derail the ship, if you like. So we took what we thought was a careful, low-risk approach. And we were fortunate because we were able to leverage existing supplier relationships. You know, you might ask, well, why didn't we look at Europe? Why didn't we look at the developing economies? But really, if you think about the relationships we had, we piggybacked on the relationships that we had with our suppliers. We talked to the BPs and the Shells and the ConocoPhillips. We talked to some of our IT suppliers and said, where can we help you? And we were dealing with the European management team. So the natural route for us was to go and develop in the European market. I'll talk a little bit more about languages later, but it was helpful that, you know, in the two largest businesses that we have, that English is the common language in both the energy and IT businesses, and that's something that's come up once or twice during the morning. And having got you know, a presence on the ground and having acquired management teams, you know, we said, look, we're going to take some time before we deploy further capital into those businesses and try and build scale to make sure that we have the right management teams. Our strategy pretty much was to use local management teams, with the exception of the finance side. We tend to put our own finance person in there. And now we feel we're in a position in some of those businesses to consider larger and maybe multi-country transactions. So some of the things that we've learned, you know, we've learned for sure that there's, you know, different cultures, and as it says there, not just from Ireland, but from one country to another. And, you know, an amusing story, when we bought our first business in France in January 2000, we completed that deal very early in January, and we pitched up at the end of January for our first management review meeting. And we got up nice and early, and we got the 7 o'clock flight out of Dublin. We lost an hour, of course, on the way, and we arrived about 9:30 in Charles de Gaulle. We queued for half an hour for a taxi. Our business was around the other side, near Versailles, and we got there in traffic and everything else sometime around 11:15. So we sat down, and there were some pleasantries exchanged, and 11:30 came, and we started our meeting at 12:15. The guy said, it's lunchtime. And off we went to lunch, and we had a very nice lunch, and we arrived back again at 2:30. The only problem was we had to leave at 3:30 to get our flight home again. So we said, look, we can't do this anymore. We've got to have lunch in the office. So we arrived the next month, similar pattern. We arrived about 11:15, and lunch came at 12:15, and we got this enormous box on the table, and we opened the box, and there was foie gras, there was a lovely duck salad, there was a tarte tatin, there was a bottle of wine, and we finished our lunch at 2:30 again. So we learned very quickly that we had to travel the night before, and I became known as a barbarian after a while, because we ended up eating rolls out of a paper bag. But, you know, that's just an amusing example, and at the end of the day, that was a culture that we changed. But, you know, you don't do that. That's not a good example. You know, you've got to adapt to the local cultures in these countries. You've got to learn them, and you've got to realize what they mean for your business. I suppose the other thing that was a challenge was, you know, different legal and tax systems. It's one market, but, you know, there are differences as you move across markets. So one of the things that we did was we have a very close relationship here in Ireland. Our corporate lawyers are William Fry. So every time we moved into a new country, because we didn't want to pitch up in a lawyer's office in Paris or Copenhagen or wherever and say, hi, we're DCC, and nobody knows who we are. So we piggybacked on those relationships and worked very closely with them. I talked about, you know, our suppliers, leveraging our suppliers. You know, one of the things we want to encourage is this pan-European approach. We want to be a pan-European distributor for our suppliers. You know, and that's something that lots of companies aspire to, but still, you know, because of the different cultures, because of the different markets, it's still a bit of a challenge. Linguistic abilities are just terribly important, and as we develop our very modest graduate recruitment program, that's something that's changed over recent years in terms of, you know, a real important criterion now in terms of assessing those graduates coming in is what language skills they have. So from our point of view, looking at the macro issues, looking at what happened through the crisis and what did we learn generally at home and abroad, and just touching on, I won't touch on all of these now. We were probably fortunate in that we went into this with a reasonably strong balance sheet, and that's something else. You don't want to enter these new markets and have a problem, as I say, whether size or your balance sheet or whatever, if it goes wrong, that is going to cause a problem. Because things will go wrong, that's for sure. We've learned lots of lessons, but we're still learning. So one of the things that worked for us was that other companies' appetites were curtailed by all that had happened in 2008 and subsequently. So there were probably more opportunities at sensible prices for us if we were able to retain our discipline, which hopefully we have done. We spent a lot of time at that stage, as we started to move our business across Europe, contingency planning, and people saying to us, what happens, if the euro breaks up? And I'm sure many of you identify that. I remember sitting at a risk committee in DCC, a few years ago, and somebody was saying, well, look, what other risks should we be thinking about? And one guy saying, well, what if the euro breaks up? And we all thought he was mad. Sort of 6 months later, he wasn't so mad. And, we had to start thinking about what that might mean for our business. The banking crisis brought all sorts of problems for everybody. We're certainly not unique in that. But again, we were fortunate in that we had, our debt structures, and we have debt low. Our net debt is fairly limited. We have debt structures, but it's all long-term debt. So that gave us an ability as well to, I suppose, in some cases, be able to move quickly when opportunities arose. The weak consumer demand, that's something that we've struggled with. Everybody's still struggling with. Again, Ronan talking about chief executives looking for organic growth this morning. Organic growth's really hard. At least we find organic growth really hard. We're looking at markets where, we don't see organic growth in, at least it's negligible, the natural organic growth in markets. So we've got to create it ourselves. We've got to try and, take market share without damaging other parts of the business, particularly the margins in the business. And then we've got to drive operational efficiency. That's something most companies have been doing for the last 4 or 5 years, but again, it's an ongoing process, and that job's not done yet. Just then, looking finally at the opportunities and risks in Europe. The outstanding opportunity is the size of the market. We're in a number of markets in continental Europe, as you saw, but there's many more that we want to be in. I should tell you that we were in 2001, 2002, we were in Italy and we were in Spain and Portugal. They didn't work for us. The reason they didn't work for us is that we couldn't get scale in those businesses. We've exited those businesses, we sold them, but over the last few years, I say, going back to our debt investors, I say if we told them we were investing in Portugal and Spain, we were going to have challenges. But those are markets, they're big markets, they're good markets, and the time will come again when we will be able to look at those. Europe is a big market, and it is open to all of us. There are benefits of the single market, and again, I think it was Gary talking this morning, we've gone so far, and it has created opportunities, but we need to go a lot further. We need to make it easier for people to do business across Europe, but that opportunity is there. And again, for us, a personal thing, we are, have an opportunity, hopefully, to leverage existing supplier relationships. The risks that are there, the stability of the euro, that's something that, hopefully we have seen move into the background, but every so often it raises its head. It was interesting with the events in Italy at the beginning of the week, the extent of exchange rate movements and just the little bit of instability that caused, but hopefully that has moved behind us. We've had a discussion this morning, Patrick talking this afternoon as well, about the relationship of the UK with the rest of Europe. That's going to be pretty important to many Irish companies trying to do business both in the UK and indeed in continental Europe. And we do have that challenge, lower growth in Europe than the rest of the world. But Irish companies have shown before that whenever they go into foreign markets, that they can outperform, and that is what we're going to have to do. Is we're going to have to outperform. But the fact that there will be lower growth in the market, starting from small positions, it's a big market, and there's plenty of opportunity. Thank you.